Hello, Jason Bates here, owner of Electrum Financial, located right here in beautiful Scottsdale, Arizona, where a mortgage is not a flip of the coin. If you like the lowest rates at the lowest cost, then allow me to put my 30 years of experience to work for you. You've got nothing to lose. Here is this week's mortgage market at a glance. It was yet another tough week for the mortgage market, with rates rising to their highest level since 2009. But how high have rates actually risen? There's a correct answer, and then there's the answer that can be gleaned from the widespread media coverage of Freddie Mac's weekly mortgage rate survey. As is often the case during times of heightened volatility, survey-based rates tend to lag behind reality. And on a positive note, Freddie correctly identified a large uptick in rates as well as their status as the highest rates since 2009. Unfortunately, the survey continues lagging behind the average lender based on an objective review of actual rate sheets, whereas Freddie moved up to 5.27%. Most lenders are at least a quarter of a point higher. This doesn't mean Freddie is wrong when it comes to rates. The survey is just limited in terms of what it can tell us regarding same-day availability of rates in a rapidly changing environment. Over long time horizons and for the purpose of getting a general sense of how rates have been moving, the survey serves its purpose. The other potential complication is that Freddie's survey has another cost component that isn't captured in headlines. In addition to the rate itself, points are also included. 1 point equaling 1% of the loan balance paid upfront in order to obtain a lower interest rate. The rate reducing power of a point can vary over time, but at the moment, 1 point is generally worth at least 0.25% in rate. For instance, a rate of 5.25 with 1 point is roughly the same as a rate of 5.5 with no points. While it is great that Freddie also publishes points, the unfortunate reality is that the media headline and consumers tend to focus on the rate itself. There's an old, popular, and oftentimes valid idea that you shouldn't pay extra points for a mortgage. It's especially valid when rates are broadly trending lower, or if there's any other reason a homeowner expects to sell or refinance in the foreseeable near-term future. You'd have to hold on to that mortgage for a certain amount of time before the monthly payment savings offset the additional upfront costs. There's also the question of what else could be done with the money today that might benefit your personal balance sheet more than the modest reduction in monthly payments. For example, paying off other debt or adding to your investments. The fact of the matter is that points are almost always simply a choice between paying upfront versus paying over time. More often than not, it was easier to make a case for not paying points during most of the past 40 years. And in many cases, that's still true. But at the moment, points can't be avoided in certain scenarios. Whether or not a loan, quote, actually shows points, there's always an interest rate and an upfront cost associated with any loan. For instance, if your lender sells your loan, the rate of the loan will determine the price the lender receives. Higher rates mean higher monthly payments, so banks that buy those loans are willing to pay more for those up front. And incidentally, this is why you, as a consumer, can pay less up front when you opt for the higher rate. Because the bank that's actually ultimately buying your loan will cover the cost you would otherwise have to pay in the form of upfront points. Your lender gets it either way. So here's the issue right now though. Due to the market volatility and the speed with which rates have risen, investors simply aren't paying up for higher rates. It always takes some time for the market and for higher rates to become active after fast spikes, and 2022 has been the fastest spike in decades. Additionally, anytime rates are significantly higher than they've been, lenders are concerned that today's new mortgages will be refinanced very quickly as soon as rates fall. Remember the point, no pun intended, about each interest rate having an associated cost? In cases of higher rates, that cost structure means an investor might front $104,000 to buy a loan with a principal balance of $100,000. They would then need to keep that loan long enough to earn at least $4,000 of interest just to break even, because they will only receive the principal balance of $100,000 when the loan is refied or paid off. Where this becomes particularly problematic is for certain loans that inherently carry big additional costs. Things like second homes, investment properties, lower FICO scores, and higher loan-to-value ratios can quickly rack up several points in addition to costs that have to be absorbed either by paying points up front or by higher interest rates. During more normal times, those higher rates would allow the investor to cover those additional costs. And at present, investors aren't offering much of a premium for higher rates. That leaves borrowers with only one option of paying those points up front. Quite simply, the market continues adjusting to a new reality where the Federal Reserve, aka the Fed, is rapidly removing the rate-friendly punch bowl of monetary policy that's been in place since the start of the pandemic. This is a topic I've covered fairly extensively in recent videos, so there's no need to belabor the point. Check out my previous videos for more information. Last week essentially brought more of the same, with the Fed confirming all of the market's fears about the pace of the rate hikes and the winding down of the Fed bond buying efforts. Keep in mind, last Wednesday's Fed rate hike has nothing to do with the week's mortgage rate movement. That rate hike was priced into the market months ago. Markets were more interested in the official announcement of the Fed's balance sheet normalization. This was also widely expected, but the details weren't fully confirmed. Bottom line, last week's rate volatility was the byproduct of traders adjusting to the details of the normalization plan. And so there you have this week's mortgage market at a glance. If you'd like to know more, reach out to me. I'd like to meet you. Thanks for watching, and if you're looking to purchase or refinance a home in Arizona, I'd like to be your broker of choice. Until next time, take care and stay safe.